My playbook for investing in a chaotic market. What are we going to cover today? We're going to talk about the nature of investing. We're going to talk about the different types of market conditions that you could be experiencing, the best strategies to use depending upon what market condition you're really in. So you have to understand the nature of investing. Real estate values go up and real estate values go down. This is just a constant. They're going to go up, they're going to go down, right? That's just going to happen. But what's important to realize is over the long term, real estate just always goes up. That's just all there is. If you look over the long term, if you look from 1965 to 2020 or 2021, you can see that house values have gone straight up. You just can't. There's just no other way of looking at this. And even if we take a closer look at the 2008 and 2009, look how fast from a 2008 to a, I don't know, what do you call this, 2014, you can see that it was here and it went down and it came back up. And it did that just within a few years, and it has now excelled past where it was. You can look at these couple of dips in values. There's a good string of going up here. You can look at some of these dips in values, and although it may seem like forever, it's usually 5 years or less when you are going over those things, and that's a very manageable amount of time if you have set yourself up properly. So let's look at this. Q1 2007, the median price was $257,400. Q1 2009, the median price was $208,000. So there's a 14% decline during that, okay? This is the country as a whole. It's gonna be different in every area, but we're basically saying, hey, values went down by 19%. Now, over the long term, rents go up. So this is rental vacancies. So you have an idea of what happens with rental vacancies during that time period as well. So if you look, rental vacancies in 2007 were 10.1%, and in 2009 were 11.3%. The interesting thing here is we had a lot going on in the housing market, and rents actually stayed steady, or they actually increased, and vacancies barely went up, a 1% vacancy. What I want to talk about for prices here, if you look at this 2008, 2009, you can actually see that prices on rents actually went up when you're dealing with some of that correction. So in 2007 Q1, it was $675, and in 2009 Q3, it was $710 for average rent. So rent prices went up during the 2008, 2009. This is really interesting, guys. So the question is, why did rents actually go up? Well, if you lost your house and you needed a place to live, you moved in with family, or you found a less expensive place that you could actually rent. This is one of the reasons why I like B+ rentals. I don't like expensive stuff. I don't like really cheap stuff. I want to be in the blue collar, average, median, or under median type levels in good neighborhoods. I do not like high-end properties when it comes to renting. More people can afford $1,500 than they can afford $3,000, which means my potential rental pool is a lot bigger than what it is if I'm only going after people that can come up with the $3,000. Now, we talked about this, the things that happen with rent during the recession. I just want to show this graph again for two reasons. One, look what happened during the recession, multiple recessions, right? So there's actually, depending upon which you count here, this area here from 2000 to 2002 was considered a recession. Rents went up. From 2007, 2008 to 2010, rents went up. You can see they dipped down a little bit. On the whole, they went up. And you can see if, right now, 2020, I wouldn't call this recession. Maybe some people would argue with me. But so all three of these in the last 23 years have seen an increase in the rental amount during a recession, whether that was having to do with real estate or other types of recession like a dot-com bubble and those types. Investing versus transacting. This is really important to realize, okay? Investing is a long-term approach. Transacting is a short-term approach to maximize returns or maximize profits. So what is transacting? Well, transacting is wholesaling. It's doing fix and flips. It's doing land flipping. What is investing? Investing is going to be rental properties, doing BRRRR type deals, selling with seller financing, doing hard money, investing in limited partnerships. That's going to be investing. Those are very different. And there is always one of two problems real estate investors have. They're always going to have one of two problems. It's either going to be easy to find the deals, but very hard to sell the deals. Easy to find, hard to sell, or it's going to be hard to find and easy to sell. And the market we've been coming off right now, it's been really hard to find and really easy to sell. You may see that pendulum start to swing just a little bit in the other direction. But my point is, either way, you're going to have a problem finding or you're going to have a problem liquidating. Regardless, you're going to have a problem in one of those areas. So you've got to know how to make money regardless of what the market is. And you've got to know how to invest regardless of where the market is. So let's just talk about this. If values went down 20%, tomorrow, okay, if real estate values went down 20% tomorrow, first off, after I got done having a parade and celebrating, okay, I would say it's time to go buy long-term properties. That's just really where it is. We saw a 20% drop in 2008. If we saw a 20% drop, I would be like, it is time to go buy rental properties, and I'm changing my strategy, which is actually really good because that is going to help me get to financial freedom. Now, I don't think this is going to happen. I don't think this is going to happen, but I really wish it would happen, because if it would, there would be a lot of opportunity for those that are looking into a long-term mindset or an investing mindset rather than a transactional mindset. Now, what happens when values drop? Well, typically what happens, the Federal Reserve typically slashes interest rates, okay? Right now we're experiencing this. Federal Reserve's raising interest rates because of inflation concerns. Well, what happens when we see values dropping? The Federal Reserve says, oh, we need to do something. Okay, we're gonna slash interest rates to encourage buying, which will help with home prices. And this leads to lower interest rates on home loans. Well, why is this important? Because if it does drop, you wanna be able to refinance or get that loan at a lower interest rate. So you've gotta be preparing yourself now for a drop if and when that ever happens. And one of the ways you can do that is get qualified for long-term financing. If you've got some problems or some things that's keeping you from getting long-term financing, go and fix those things now. Clean up your late pays, clean up judgments, collections, whatever it is. Clean that crap up, because you want to have yourself in a position that if the market does take a turn, you are able to acquire those properties, fix those property up, refinance those properties, rent them, see the rents increase over time, and see the property values go up over the long term. That is the goal and what we are working towards. Document income, you wanna make sure you have documented income. So go right now, talk to a mortgage broker right now. I'm not talking about a hard money lender like ourselves or a private money lender. You need Chase, Bank of America, Wells Fargo, whatever, your credit union. You need a company, a bank, a credit union that's willing to give you 30-year financing on an investment property. The good news is lots of them are willing to do that, but you wanna know, what is it gonna take for me to be qualified? Now, one of the things you've gotta keep in mind is with the income you're getting from the rental, that gets added to your income, which makes your debt to income ratio look a lot better, because it's not just an expense, it's also an income. So what you need to do is, on a rental property, or do a type of a BRRRR deal, okay? The BRRRR deal is going to be where you buy it, you renovate it, you rent it, and you refinance it with that lender that you need to go get pre-approved with. So what to expect if the market actually slows down? Well, a couple of things you need to realize. It's gonna take longer to sell homes. It's gonna take longer to sell fix and flips. It's gonna take longer to sell wholesale deals. That's inevitable. That's something that happens as a market slows down. Remember, you've got one of two problems: hard to find, easy to sell, easy to find, hard to sell, okay? Property selling for less than they normally would have sold for, right? They're gonna sell for a little bit less because the interest rate's doubled. And so if the interest rate doubled, I can't buy as much as a buyer, which then means I am going to have to either negotiate or not buy a house. So take the lower of the solds and actives. This is one of the ways you want to be pricing when you're pricing your home, to say, hey, how do I deal with this in a turbulent market? Well, lots of people just use sold comps. They say, hey, you know what? I am going to base my property on what sold comps actually went for. Well, that only works if it's a rising market. If it's a declining market, you want to be looking at actives as well, okay? So you want to look at sold properties and you want to look at active properties. And with your sold and your active properties, you want to say, what are the lowest of these? then you can do whichever is less of the sold and actives. Actives will likely sell for less than what they're actually listed. So if they're listed for $100,000, they're not going to sell for that $100,000. They're going to sell for less than that. So maybe you want to say they're going to sell for $95,000. Take 5% off or 3% off or something like that. But we're looking for the lowest your solds and actives, and we want to make a determination. If they are actives, you can take off a 5 to 10% of what you think they're actually going to be selling for. Now, if the market is going down, sold properties will be higher priced than active properties. This is so important. This is what I've been talking about here. Your sold properties will look better than what your active properties are on the market. And if you're not used to looking at actives and looking at solds, you can get yourself into some trouble here, because yes, that property might have sold last month for $150,000, but if there's a neighbor trying to sell theirs for $140,000, that's a very, very similar house, you're not going to get $150,000, and they may not get the $140,000. Now, this is in a declining market. These are things you need to look at, and I would be looking at them now because you don't know what's going to change. So if you're looking at the actives, you're looking at the solds, you can have a better idea of what's changing and when it is changing. Now, according to Forbes, income-producing real estate is the best hedge against inflation. Unlike stocks, bonds, and mutual funds, investing in real estate can make inflation actually work for you, meaning increasing your income as inflation rises. That's why real estate is the best to hedge against inflation. So, the big thing I'd say in this playbook for a KDOC environment is don't stop looking at properties. Don't stop looking at properties, okay? Just be more selective for the best deals. Don't do any deal, just do the best deals. And average deals, you probably want to pass on. If it's an average deal, no thanks. I want the best deals. I want to be selective. Let's just jump into a little recap here, guys. What you have learned. Real estate values go up over time. We've talked about that. We've seen that. You've seen the graphs. It only took 2 years for values to go from the 2008 low to where they were before. 2 years. That was it. Housing only had a 19% decline in values during that 2008, and rental amounts went up, meaning they were higher in 2008 than they were in 2007. Vacancies did go up, but they only went up 1%, which I don't think is that substantial, something to keep in mind. But if rents are going up, I'm less concerned about that vacancy going up 1%. Rent prices just go up over time. They just go up over time, and rental prices go up when there is a recession. Rents have gone up. Historically, that's been the case on all of these as we look back over the last 65, 75 years, something like that. If there is blood in the streets, if you see a 20% decline in values, you want to buy rental properties. Go buy rental properties. If there is a slowdown, a price, you want to be using the lower of the solds or the actives. Even if you're seeing a price drop or a price slowdown, you want to be using the lower of the solds or the actives to make your determination as to what your property will actually be selling for. It's really important. And then if you are using actives, you want to take another 5 to 10% off before you put that final value in there. Next, get credit worthy for long-term financing. If you want to get to financial freedom, one of the things that can help drastically is being able to get low interest loans from banks on rental properties and leverage their money at a much lower interest rate. It's going to help drastically start working towards that. If you have some things you can do, start taking those actions and working towards it. Now's a great time to do that. And lastly, do not stop finding properties. Don't stop finding properties, but be selective. And we're only going after the best deals. We don't want to go after mediocre type deals.